Welcome back to Real Estate Beast, where we dive deep into the world of real estate investing. I'm your host, Michel Kmiotek, and in today's episode, we're exploring the fascinating topic of real estate cycles. Whether you're a seasoned investor or just starting out, understanding these cycles is crucial for navigating the complexities of the market and making informed investment decisions. So, let's dive in. Real estate cycles are a fundamental aspect of the market, characterized by the recurring pattern of ups and downs in property prices, supply and demand dynamics, and overall market activity. So, these cycles typically follow a four-phase pattern. Number 1, expansion. Number 2, peak. Number 3, contraction. And number 4, the trough. So, during the expansionary phase, the real estate market experiences a robust growth, usually fueled by factors such as low interest rates, population growth, maybe labor migration, and strong investor confidence. Property prices rise, demand outstrips the supply, and developers respond by increasing construction activity to meet the growing demand. They are greedy and they want to build to make money. The best example for this phase is, of course, Dubai, a city known for its ambitious skyline, luxury lifestyle, and this dynamic economy. They experienced a significant expansionary phase in the real estate market during the early 2000s. It was fueled by a booming economy, rapid urbanization, and ambitious development projects. Dubai transformed basically from a desert outpost into a global metropolis seemingly overnight. One of the key drivers of Dubai's real estate expansion was its strategic location as a gateway between East and West, making it an attractive destination for businesses and investors and tourists alike. Now, as the city emerged as a regional hub for trade, finance, and tourism, demand for commercial and residential properties soared. Developers responded to this growing demand by launching ambitious projects that redefined the city's skyline and also reshaped its urban landscape. There were iconic landmarks such as the Burj Khalifa, the world's tallest building, and the Palm Jumeirah, I hope I pronounced that correctly, which is basically a man-made island in the shape of a palm tree. I mean, who can come up with this stuff? It captured the world's attention and cemented Dubai's reputation as a global destination for luxury living and investing. And so, the expansionary phase of Dubai's real estate market was characterized by unprecedented growth. It was fueled by factors such as low interest rate, easy access to financing, so basically you could get a loan for whatever they were going to build, and it had a wave of optimism and investors had a lot of confidence in Dubai. So, property prices skyrocketed with luxury villas, high-end apartments, and commercial office spaces commanding premium prices. Sometimes these luxury villas and high-end apartments were never even rented out. They were just sold from one owner to the next, and sometimes in the course of just 1 year. An apartment could see 3 different owners, and basically the price just kept on growing and growing. This, my friends, is pure speculation. And thus, investors from around the world flocked to Dubai, eager to capitalize on the city's meteoric rise and take advantage of lucrative investment opportunities. Speculative buying became, therefore, commonplace, as investors sought to cash in on the city's booming real estate market and capitalize on the promise of high returns. But as the real estate market in Dubai reached its peak, the city buzzed with activity, with construction cranes dotting the skyline, investors flocking to purchase off-plan properties and anticipating of the future appreciation of these properties. Now, the city's population swelled as expats from around the world flocked to Dubai in search for employment opportunities and, of course, to get a slice of the city's glamorous lifestyle, what have you. But businesses thrived, luxury shopping malls flourished, and tourism boomed as visitors flocked to experience the city's iconic attractions and world-class amenities. I mean, you could find super high dining restaurants, attraction parks, there was great shopping. Dubai really became a symbol of prosperity and opportunity. So, investors were attracted, entrepreneurs wanted to establish their businesses there, and tourism from all over the corners of the entire globe came to just experience what Dubai was all about. Another example, Luxembourg, my home country. It's small but prosperous. It's in Western Europe. It's also currently experiencing a peak phase in its real estate market, fueled by factors such as economic growth, population expansion, and foreign investment. Property prices in Luxembourg have also soared to unprecedented levels, making it one of the most expensive real estate markets in Europe. One of the key drivers for Luxembourg's real estate boom is its thriving economy, which is powered by a diverse range of industries, including financing, tech, and logistics. The country's favorable business environment and low taxes and strategic location in Central Europe have attracted multinational companies and high net worth individuals as well, and they basically drove up demand for commercial, but also for the employees. The residential properties were needed, and so prices went up. Now, Luxembourg's population has grown steadily in recent years, fueled by immigration and natural population growth, and the influx of the new residents has put pressure on the housing market, leading to an increased competition for limited inventory and pushing prices up and up and up. And so, the peak phase of Luxembourg's real estate market is basically now characterized by robust demand, limited supply, and soaring property prices, particularly in prime locations such as Luxembourg City. And of course, some of its surrounding suburbs and the south as well, although at a lesser degree. Now, luxury apartment, penthouses, and villas command premium prices, but also the developers want to put out higher and higher, more luxurious type of buildings while giving less and less square meters to their buyers. It's basically becoming a bubble at this point. Now, foreign investment has played a significant role in driving Luxembourg's real estate market to new heights, and investors seek, of course, stable returns and diversification, so they have poured into the capital and bought up a lot of real estate, which drives up prices even more and fueling, basically, once again, speculation on the market. However, now that it has reached its peak phase, there are risks and challenges associated with Luxembourg's booming real estate market. Affordability has become a growing concern for local residents. We often hear how parents exclaim their worries by saying, well, my children, they cannot buy anything in Luxembourg and they will have to basically buy something abroad just across the border, which is not that far away, but you will be into a completely different tax system, become a resident of a different country, and so on. In any case, local residents don't want this for the next generation. So many of whom are struggling to afford homes in the city center or in popular neighborhoods. And there are also concerns about the sustainability of the market. There were the issues with the entire banking industry in 2008, and then we had the COVID pandemic. All in all, we see now that prices are going down since the interest rates went up after a geopolitical incident. Of course, that's the Ukraine and Russian war. So, they have issues. Anyway, back to the cycles. As the market reaches its peak, signs of overheating may begin to emerge, so that's when speculative behavior becomes prevalent and property prices reach unsustainable levels. Eventually, the market enters a contradictionary phase. It's characterized by declining property prices, weakening demand, and increased market uncertainty. Let's get into an example. Vancouver, its housing market also experienced a period of overheating characterized by rapid price appreciation, speculative behavior, and then the affordability challenges arise. So all of this was fueled by factors such as low interest rate, foreign investment, and limited housing supply. It's always those three factors which come into play. And property prices soared to unsustainable levels, outpacing income growth and fundamental market values. One of the key drivers of Vancouver's overheating housing market was an influx of foreign buyers, particularly from China, who sought to invest in the city's real estate market as a safe haven for capital and a hedge against economic instability. This surge in demand, coupled with limited land availability and zoning restrictions, put upward pressure on prices and exacerbate affordability challenges for local residents. Speculative activity also played a significant role in Vancouver's overheating housing market, as investors and speculators sought to capitalize on the promise of quick profits and high returns. Flipping houses became a very popular strategy, with properties being bought and sold multiple times within short time frames, often without any significant improvements or renovations. As property prices continue to climb, fueled by speculative buying and foreign investment, affordability became a growing concern for the residents, and many locals found themselves priced out of the market, unable to afford homes in the neighborhoods where they grew up or work. In response to mounting pressure, the government implemented various measures aimed to cool down this market and to address the affordability issue, including foreign buyer taxes, vacant home taxes, and restrictions on short-term rentals. While these measures helped to temper price and stabilize the market to some extent, they also led to a slowdown in activity and a shift in investor sentiment. However, as the market cooled off and affordability challenge persisted, Vancouver's overheating housing market eventually reached a turning point. This is when speculative activity wanes, foreign investments slows down, and the property price stabilizes. This also leads to a more balanced and sustainable market environment. So during the Trough phase, the market reaches its lowest point and property prices stabilize or begin to recover. Economic indicators such as declining unemployment rates and easy credit conditions contribute to the recovery phase, and investor confidence gradually improves again. Another example, in the mid-19th century, New York City experienced a period of unprecedented growth and prosperity. I'm sure you're well aware of it. Fueled by factors, usually such as industrialization, immigration, and of course, an expansion of trade and commerce. However, by the late 19th century, New York City began to experience a downturn in its real estate market as the initial boom gave way to economic challenges and market saturation. The expansion of the railroad network and the development of other urban centers led to increased competition for trade, commerce all around the country. So, while technological advances and changing consumer preferences reshaped the city's industrial landscape, so this resulted all in property values in New York City to be in decline. Vacancies increased and construction activity slowed. Many of the grand commercial buildings and residential properties that had been erected during this boom years now stood empty or underutilized, their owners struggling to find tenants or buyers in an increasingly competitive market. The Trough phase of New York City's real estate market was characterized by economic uncertainty, financial distress, and a sense of delusionment among investors and property owners. Many speculators who had rushed to invest in the city's real estate market during the boom years now found themselves, of course, facing significant losses as property values plummeted and demand waned. Foreclosures and bankruptcies became commonplace as property owners defaulted on their mortgages and struggled to meet their financial obligations. So the once bustling streets and neighborhoods of New York City now bore the scars of economic hardship. It had vacant storefronts, boarded up buildings, and abandoned properties basically dotted the urban landscape. However, despite the challenges and setbacks, New York City eventually began to emerge from the Trough phase of its real estate market, fueled by factors such as economic diversification, urban renewal, and government intervention. The construction of iconic landmarks such as the Brooklyn Bridge and Statue of Liberty helped to revitalize the city and attract new investment and tourism. Over time, New York City, of course, as we know it today, had a real estate market that rebounded, property values stabilized, and confidence returned to the city as it embarked on a new era of growth and prosperity. The lessons learned from the downturn helped to shape the city's future development, leading to the emergence of new industries, neighborhoods, and opportunities for investment. And now we see again that it's going through a new cycle. So it basically happens over and over again, especially in major cities around the world. So, real estate cycles. Much like the tides, they ebb and flow in a rhythm that can be both complex and unpredictable. While some cycles may unfold over the span of just a few years, others can stretch across decades or even centuries, shaping the destiny of the cities and regions in a profound way. In some cases, real estate cycles can be short-lived and super intense, resembling the frenzied boom and bust cycles that we saw during the gold rush era. During these periods, cities may experience rapid growth and prosperity as speculative fervor drives property prices to dizzying heights. However, just as quickly as they rise, these markets can come crashing down, leaving behind ghost towns and abandoned developments in their wake. Take, for example, the gold rush cities of the 19th century, which flourished and faded in a matter of years. This was just because prospectors would flock to them, to newly discovered gold mines, only to move on to the next boomtown when the riches had run dry. These short-lived cycles serve as a reminder of the volatility and uncertainty inherent to real estate markets, when fortunes can be made and lost in a blink of an eye. On the other hand of the spectrum, there are real estate cycles that unfold over much longer time frames, spanning generations or even centuries. So these enduring cycles are characterized by gradual shifts in demographics, economics, and urban development, as cities evolve and adapt to the changing circumstances over time. Take, for instance, the city of Rome, whose real estate market has witnessed countless cycles of growth, decline, and rebirth over the course of its storied history. So from the heights of the Roman Empire to the depths of the Dark Ages, Rome's real estate market has weathered the test of time, demonstrating resilience and endurance in the face of adversity. Whether short-lived and intense or long-lasting and gradual, real estate cycles play a crucial role in shaping the fortunes of cities and regions around the world. By understanding the diverse timeframes and outcomes of these cycles, investors, homeowners, and policymakers can better navigate the complexities of the real estate market and plan for the future with confidence. So it's essential for real estate investors to understand the cyclical nature of the market and to adapt their investment strategies accordingly. So by recognizing the signs of each phase of the real estate cycle, investors can make more informed decisions about when to buy, sell, or hold their properties. Ultimately, it's all about maximizing your returns and minimizing your risks. So, how can an investor navigate the complexities of the real estate cycles and capitalize on market opportunities? One strategy is to adopt a long-term perspective and focus on fundamentals rather than short-term market fluctuations. By conducting thorough market research, analyzing economic indicators, and assessing local market conditions, investors can identify undervalued properties with strong potential growth. You have to do your homework, obviously. Another strategy is to diversify your investment portfolio to mitigate risk and hedge against market volatility. This is usually at a later stage of an investment endeavor when you have multiple properties over multiple countries and you are now trying to really get rid of a lot of that risk and stabilize your real estate investment income. By spreading your investments across different asset classes, locations, and property types, you can thus minimize the impact of downturns in any single market or sector. Additionally, I think it's important to maintain financial discipline and avoid succumbing to the lure of speculation or herd mentality like we have seen it in Dubai. Stick to your investment plan, stay patient during market downturns, and resist temptation to make the impulsive decisions based on short-term market movements. Lastly, consider seeking guidance from experienced real estate professionals, such as real estate agents, brokers, or financial advisors. Their expertise and insight can help you navigate the complexities of the market and make more informed investment decisions. So, that's all for today's episode of Real Estate Beast. Thank you for joining me on this exploration of the diverse timeframes of real estate cycles. Be sure to tune in next time for more insights, tips, and strategies to help you navigate the world of real estate investing. Until then, happy investing.